Good morning, good morning, good morning, good afternoon, good evening, depending on what time you're watching the video. It is Sunday, April 16th. Blink 182 at Coachella was epic. I wasn't there, I was watching it, but epic. Absolutely epic. Uh, Try and cut this down, not to be a long winded video. So I'll start you off here with the spreadsheet. Still going on the spreadsheet. March 24th, 3909. You guys remember it. We had a very oversold NASDAQ 4 hour. We knew that we were going to be getting a bounce. We got a bounce. We closed since that day. We went into those range tightenings where we were getting 33 points and 27 and 31, and we were having the gaps, those unfilled gaps that we had below us during that last week of March as we went into the end of the quarter. And then in April, we started the same thing where 28 points, 27 points, 37, 37, the lowest of the year that wasn't a half session on Thanksgiving, 21 on April 11th. And then we started to widen up a little bit over here the last couple of days, around 50 points on average. And we did get that 41.63. We did fill that gap up there at 41.56 that was needing to be filled. And it's all over, right? Well, let's see, because we've got, again, I'll zoom you out and I'll zoom you in and bring you back and forth from where we need to go. But we've now just put in 5 green weeks. 1, 2, 3, 4, 5. 5 green weeks in a row as we came up here. You had 4 over here in August, and I want to focus on that for a moment. As you came off that June low, you had a little bit of a bounce, very, very oversold. You guys all remember. And we had 4 green weeks as we went in to post the high, which came on the full moon, which I'll show you in a minute, right over here in August at 43.25. Now, back here in August, coming off of that July bounce, June bounce, we had 7 trading sessions without a minus 1% dip intraday. And then over here on August 5th, we had a minus 1% dip on a gap down, 41.52 gap down to 41.16. We hit 41.07, which was well below our 41.10 minus 1% level for the day, and we wound up closing up above the open but below the previous close for a red day. Doesn't matter, we're counting the minus 1% here. Then we went on to have 7 more sessions in a row, and that was where we put in our 43.25, 2 days after the full moon back there in August. So technically, if you want to take that one day out, you had 15 trading sessions without a minus 1% dip, and it came into the August high. Where we're at right now is 14. We've got 14 trading sessions without a minus 1% visit intraday. So coming up that we had filled that pesky gap, that 41.37, 41.46 from back in February. I'm a little bit questionable here with the full moon, and I'll go over that later. How 2 sessions prior you had 41.33. On the full moon, we have the low of the month at 40.69. Current low of the month, 40.69. And now 5 sessions after the full moon, 41.63 comes in. Now, I've tracked this very well going back, and even here in March, this kind of threw me off a little bit because it was 4 sessions after the full moon, that 38.08. I've not seen a width this far away from the full moon. However, I'll give it an asterisk for the moment, only because it is, it is what it is, and we've got a lot on our table for this week. That 40.69, 40.70 would obviously be a big level, and then we have those gaps underneath. So I won't waste too much time on this. Again, just sticking with you here, looking at your 5 weekly candles. again, these numbers here, 3477, 1184, 3448, 2754, these are about the presidents. Now, Donald Trump had a 34.77% run before he got a 10% dip. Biden had a 34.48% run before he got a 10% dip, which wound up being this 27.54, which went down to the October lows. So here we are. And again, just from a chart point of view, this 4136.15 is your 161.8 retracement from the COVID drop. If you check out over here, this 3308.21, that's your 161.8 retracement from the 2018 drop. And as you can see, it almost worked out perfectly for where the top was prior to COVID. And one of those reasons we were getting a little bit aggressive to the short side prior to COVID. Hang on a second. Excuse me. So, 5 green weeks. Bring you out and zoom out so that everybody has a better understanding. And we haven't done anything wrong still. You can see this channel that we have been in since 2009, and we haven't really done anything wrong. We've been still riding along this channel, even when we came into our lows over here. Now, when we came into our lows, you can see your December lows of 2020 or 2018. You've got your lows over here in October, the lows that we've been recently placing. We're still inside this channel that you can go back, all the way to 2009. We're still in the channel. So there's nothing that's actually taken place other than the initiation of this downside move. And if you can look over here, which I'm trying to just display, is how you have a running sell divergence, which has been going on for years on the weekly. Every time you're getting overbought on the weekly, it's getting weaker and weaker as to the overbought, where all the power was all used up as it was going into COVID. That's where all of that buying power was at. All of this buying power over here was right there during Trump, as it was running into Trump's big run. And then, bam, you started getting weaker and weaker and weaker. So it's not it's something to notice, but definitely with 14 trading sessions without a -1% visit, I would obviously be very, very attracted that you are going to get a -1% visit as you move into the rest of the week. And this being OPEX week, your main focus still continues to be over the course of this year, where all of the money is in your 7 weight stocks, all of it. Now take over their little brothers and sisters. Yeah, you've got AMD over here. Come over here with Amazon and Tesla. You don't have any friends. And you start looking over here at your financials, which got a little bit of a bounce there on the end of the week last week, where you got Visa up 12%, MasterCard, American Express. What happened to the credit crunch and the blah, 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 and the blue, blue, blue with the credit cards? So that's where you're at as far as you look from your wider point of view from the year. Again, looking here onto your wide view, you haven't really done anything wrong. There hasn't been any wide damage as of yet. So coming here and looking at the weekly, and again, with the weekly, how you can see how you did have this big buy divergence as we were going in here to the June lows and the October lows. It made it very clear. Now, again, as we're floating in this little 4136 level, 4150, you can see that you have a little bit of weakness here on the weekly. Not a confirmation, but a little bit of weakness. And as you look over here at your 50-day weekly, which is the same as your 200-day moving average, it has been crossing over and heading down bearish for quite some time, while your 200 weekly is a completely different story, because that's basically where your bottom is. And your bottom's at 37.55 for the moment as it continues to climb up. Over here on the daily, what I've done is colored out some areas for you. And as you can see down here below 38.50, this is your just get out of jail free card. Buy as much as you can possibly buy. Up here above 4,300, you haven't been there. So you can forget about that, because your yellow level right over here, 4,100, 40.50, is where we have continued to fail for months and months and months and months and months. And as you look over here on your daily, we now have a pending sell divergence on the daily on the SPX. SPX being just the torso of the stock market. It takes the other components, the legs and the two arms, in order to make something happen. So we come over here and we look at the NASDAQ. And on the NASDAQ, looking here, you can see what I'm trying to just share with these red boxes on where your MACD crossovers take place, and on the green boxes where they take place for the bullish side, for the upside. And as you can see over here, we are just crossing over bearish over here on the NASDAQ as we are floating above this 12,800 level, which has for months and months and months been the same as that SPX 4100, 4050. And we're floating up above it. And we have a pretty clear sell divergence sitting here waiting for us to confirm, which will give us a fractional little bit to the downside with your 50 and 200-day moving crossover that took place over here in March, which never got wasted and never got tested. So that is sitting there with your NASDAQ. Come over here onto your NASDAQ weekly, and again, same thing. Crossing over here in red where your bearish crossovers are on the weekly, green on your bullish crossovers. And right now we have a kiss. We have a kiss on the stochastics right over here on the NASDAQ as we are sitting here pending with an overbought weekly candle. As far as the RSI goes, we are sitting here overbought. It is a very questionable period where we're at. And as you can see on the gray areas, you've got your 12,800 where it's kind of where you're a little bit too euphoric right now. You can see it supporting back here in early 2021. This is a test zone which needs to be tested and needs to be proven. And you have a lot of tech companies that are going to be reporting in the coming weeks. This week, I'll show you those as we go into that with Netflix and Tesla. The Dow. You couldn't get more boring. But again, same thing. You are looking at this big line right here, right around 34,000, and how it has been just pressing above it for months. In months, we've been doing this. And still the same thing. Been a strong resistance area back here in August, floated up above it during November and December, just continued to fail on it during January and February, and here you are. On your Dow, on your daily, you are about as excessively overbought as you could ever expect to be. Running overbought over here since the end of March as we had that push. Your stochastics have absolutely no idea what in the hell to do. And you can see this pretty damn clear just wedge that needs to be answered while you've got your 50-day and your 200-day sitting there waiting below right around your December lows. We're not looking for a rug pull. What we're looking for is a dip. We're looking for a dip. And then you come over to the IWM, the Russell 2000, and, looking over here at a weekly, and again, just trying to show different ideas, talking money flow over here, as you can see, is negative and moving downward. This 170 zone, just how end of the worldish that it is, with 165 being the, either grab a life raft or you're going to drown. And as you look over here, looking on your weekly, and you can just see that every time it touched up here, getting a little bit overbought or getting overbought, you had your big sell downs. We got our little overbought right there at the end of the month as we went into April, after being very oversold when we came down here to that 167.46. IWM not really helping things out. And, the more you come over and look at it on a daily chart or even on a weekly chart, you're not getting any help. More importantly, which is pretty scary, your 50 and your 200 weekly, not daily, weekly, are attempting to cross over bearish. And I don't know, man. I don't know if I would be buying at 165. I'm expecting that you're going to start seeing, 150s and 140s. And we'll find out a little bit more about that as we go into this week with the regional banks that'll be reporting. So we come over here onto the VIX, and everybody's become a VIX expert now. And what you need to know is the VIX is calculated based on the 30 days moving forward option flow on the SPX. That's what the VIX is calculated on. Now, if nobody's buying 30 days, meaning from today to 30 days from today, then the VIX is pretty weak. If somebody goes out and buys December, they buy September, it makes absolutely no effect on the VIX whatsoever. So with everything being focused down on the 0 DTE over on SPY, this is exactly why you're getting your compression on the VIX. And as I was saying for a couple of months ago, a month ago, when the VIX is reliable is when we're getting a move to the downside. When the VIX is unreliable is when we're getting a move that is floating sideways with a fractional incline. And as we've been down here for multiple visits during the course of 2023 at this 1811, we are at a prove it to me point of view right now as we're down here at 17. Zoom out, look at a wider view of the VIX. You've got your very, very wide support levels being tested right now. And as you can see here, you've got a very wide buy divergence on your weekly as you have your resistance falling down there. And it is very rare to see a visit in the 30s. If you start seeing multiple closes in the 30s, like I messaged you back in March when we hit the 30s, if you're seeing multiple closes in the 30s, we're in big trouble. But you look back at your emails going back into March, and I emailed that out. Be careful because the VIX is here in the 30s. Don't overcommit yourself as to what you're looking with. So, with all of that, as I go into the charts real quick, 5 green weeks, right? I have no choice but to be extremely aggressive with this week's trade of the week on the SPX, and that is buying the 4160 calls, selling the 4155 calls at the moment, making an even more aggressive trade of the week view after we get our opening print on Monday morning to make sure that we are looking for a close below the open on Monday. And bring you over here to the charts now. And again, this being a zoomed out version of where we came from to where we are. I will zoom you in now, but more importantly, in this blue line, that's your 400-day moving average. So we made an attempt over here in August to make contact with it. It made happen. Same thing happened here in February. Same thing is happening right now as we just came into that high there on Fridays. So I'll zoom in here thinking, nope, that's not going to work, but that will. And again, here's your 400-day moving average that you can see up here. Again, not a moving average kind of guy. I'm more of an Elliott wave chart counter. Whether this is 1, 2, and that was 3 for the C, or this is your 1, 2, and we're floating around here with a flat, everything is pointing up here to 43.75. Everything. It has been for weeks. We've been talking about it since October. Everything is pointing up here to 43.75. Everything. Are we getting it now? I do not see that. And I do not see that only because of how many gaps that we have unfilled moving back there to where we came from, and the fact that we've been counting this as a failed 3, a move to the downside on the A, and a move to the upside over here on the B, where we should be looking for a C wave to the downside. And then we can start to adjust to be looking for the summer run, which should make us up there in the 43.75s. Basically, we're looking for a great buy the dip. Not a little visit over here at 3808, which we knew we were going to get the upside move anyway because that was the move down that we were looking for from February. But we're looking for a great buy the dip. We didn't get that back there in March. We didn't have an oversold daily, everything sitting there screaming, this is the time to do it. We got a 1-day half of session visit, the VIX in the 30s, saying, oh, you better be careful. You're going to go down. because we were looking at that 37.65 area. So that's where we're at with this, and bringing you in again to what we work with. Here is where we are. This obviously needs to be adjusted because it was moved up higher at 41.63. But here's your move off of that 39.09 where we have had no minus 1% days. We have our gap over here, which needs to be filled. We have our gap here that needs to be filled. We have our gap here that needs to be filled. We are above, and that 5-day moving average and 10-day moving averages are your lifeline at the moment. 40.64, untested since we broke up above there back on March 31. 40.64 is the beginning. If we can get a break below 41.60 or 40.64, we get a break below 40.64, then we can start looking at 40.20 and looking down there at that 39.50 area, 39.75 for that gap. Until we can get 40.64, all we're doing is wasting time. We're up here at this 41.36, eating it all day long on Friday, over here earlier on Monday, over here last week. We're right there. But again, you've got your 50 retracement of the entire 2022 drop right here at 41.55. Scares me to think that we may have had our whole bear B bounce and we're already going to start moving into the C, but the charts aren't set up for that. The charts in no way are the charts saying we're heading down for that big bear B move down to the 2200s. Nothing in the charts is saying that at all. So that's why I'm still looking for a dip down here. Perhaps test the 200-day moving average back at 39.50. I would love to see a little bit lower around 3900 and then aggressively start buying as we go into the second half. So we've got earnings coming up, but before we go into earnings, I'm going to be looking over here at Meta, because with Meta, it's been a topic. I got short in June 175 puts a month ago. Obviously, being up here at 222, they're underwater. TikTok, due to get a ban, makes Facebook that much greater is complete bullshit. But anyway, here is your 5-day. All right, here's your 5-day. And the reason I brought out Facebook to talk about it is because it came up here to this 218.62, which is your July 2018 and your pre-COVID highs. So what I want to do here is I want to zoom out, and now you can see where Facebook is. And you see this euphoric, absolutely fucking euphoric run that you've had here on Facebook. And you're right back up here to this 218.62, your pre-COVID highs. You obviously had your big COVID run, and this is your major gap to be filled over here from back in February of 2022, and all of this move to the downside. You've got multiple gaps to be filled down there below, but again, what we are looking at here, so that you understand, 294. It's above 294. That's your 50 retracement to the all-time lows. That's where you're at on Facebook. So, this to me tells me you want to be selling as much call credit as you can possibly get involved with. 236 is fantastic. Anything above that 220, all they're doing is trapping the shit out of people that are buying this. So we move on to Netflix, which is going to be reporting this week on Tuesday after the market close. And here's your 5-day on Netflix. 330, 347, a little bit of a dip. A lot of 1-minute guys going, yeah, look at this. So here's your 90-day view on Netflix. And you know what? I'm going to throw this up here just because I know I don't have it. 0.5. And look at that. Here is your Netflix. Banner? Yeah, banner works. Here's your Netflix. The drop came down to 75% from the all-time highs. This 2022 drop. And now you've had this bounce all the way over here, almost a year now, since May, which is taking you back to 50% from the all-time highs. 50% from your all-time highs. And you've got earnings coming out on Tuesday. Tesla, 5-day view on Tesla. Tesla, 176, 190, 150, floating around nowhere, closing right there at 185, only down 90 cents there on Friday. So let's zoom out. Let's just look at a 90-day, because on the 90-day, we can see where the lows were as we got that run up there to that 217, and how it's been resisting right at that 208, 207 level. Let's zoom it out. Take this off, and Tesla is resisting at 50% from its all-time highs. The lows that you hit over there were 75% from the all-time highs. So the point being, what I'm talking about here is how everybody wants to say it's a bull market, the bear market is over. Motherfucker, when you got stocks that dropped 75% from their all-time highs within a year and are now resisting 50% from their all-time highs, and they are your heavy weighted stocks, ain't no fucking bull market. We are in a bear B bounce. And the bear B bounce is what we're looking at here, where this was your A wave down. This is your B wave up. We should be going into the 4350s. Should even be going up into the 4630s. And then we're dropping down to the 2200s. And that's not going to be like COVID, where it happens in a couple of weeks. That's going to be a progress of a few years. You start zooming out further and further and further, and you start realizing where you actually are. And then you see your 50% reclines, your 50% reclines over here in 2001, 2009. It's coming, and AI is going to be the reason they blame it on. So make all the money we can make right now. Continue to do it, because the heat map is telling you that everything is inside of 7 stocks. 7 stocks that weigh 50% of the QQQ is where everything is at. Stay focused, stay relaxed, stay in the chat room, stay happy, and most importantly, get ready for Monday. Have a great weekend.